There's an extra charge buried in a lot of Florida mortgage payments, and it protects somebody, just not you. It protects the bank. It's called PMI, and buyers either panic about it or don't understand it. So let me clear it up. What it really costs here in Florida, how to make it disappear, and how to skip it entirely if that's the smart move for you. I'm Ryan Solberg with MaxLife Realty. I've walked hundreds of Central Florida buyers through this, and here's the headline. PMI is usually smaller, more temporary, and more avoidable than people fear. For a lot of buyers, it's actually the thing that lets them stop renting years sooner. First, what PMI actually is. Private mortgage insurance is a policy that protects your lender if you default and the home sells for less than you owe. It only shows up on conventional loans and only when you put down less than 20%. The logic's simple. A buyer putting 5% down is riskier to the bank than one putting 20 down. So the bank wants insurance. You pay the premium. The bank gets the protection. But don't let that sour you on it. PMI exists so you don't have to save a full 20%, often $80,000 or more, on a Central Florida home before you can buy anything. A modest, removable PMI cost beats spending several more years renting while prices keep climbing. So, what does it cost? PMI usually runs about a third of a percent up to 1.5% of your loan amount every year, paid monthly. Three things drive your rate: your credit score, your down payment, and your debt to income ratio. Better credit and more down means lower PMI. Here's roughly what that looks like in real dollars. On a $300,000 loan, somewhere around 125 a month with good credit, up to 250 on the higher end. On a 400,000 loan, call it 167 up to 333. Your loan officer quotes the real number, but you can see the point. It's a real line item, but it's rarely the budget buster buyers imagine, and it does not last forever. And that's the part that should make you feel better, getting rid of it. On a conventional loan, PMI is temporary, and you've got four ways to end it. 1. Once your balance drops to 80% of the home's original value with a solid payment history, you can formally ask your lender to cancel it. 2. By federal law, your lender must automatically drop PMI at 78% as long as you're current. You don't lift a finger. 3, and this is the Central Florida special. If your home has appreciated, you may already have 20% equity even if your loan balance barely moved. Pay for a new appraisal, prove the equity, request cancellation early. And 4, refinance into a loan with no PMI, just weigh the closing costs. Now here's the biggest mistake I see people make. They think FHA mortgage insurance is the same thing as PMI. It is not. FHA loans don't have PMI. They have something called MIP, and it works very differently. FHA charges an upfront premium of 1.75% of the loan, plus an annual premium, and on most FHA loans today, that annual cost lasts the entire life of the loan. It does not fall off at 20% equity unless you put 10% or more down. So buyers who chose FHA to qualify more easily often end up refinancing into a conventional loan later just to shed that MIP. Don't assume the two are interchangeable. Confusing them can cost you for 30 years. And if you'd rather skip PMI from day one, you've got options. Put 20% down or do an 80-10-10 piggyback, a first mortgage for 80%, a second loan for 10 and 10% down. VA and USDA loans skip PMI entirely if you qualify. But here's my honest take. Often you shouldn't bother avoiding it. 20% down ties up a big chunk of cash you might want for reserves and repairs. For a lot of buyers in an appreciating market, putting less down, accepting temporary PMI, and keeping cash on hand is the smarter play. Bottom line, PMI is a small, usually temporary cost that buys you the ability to own years sooner. It's a tool, not a trap. I wrote the complete version of this, every removal method, the FHA trap, and how to avoid PMI altogether, over on the blog. And if you want a clear, honest breakdown of whether to put more down or keep your cash for your actual situation, that's exactly what I do. Call or text me at 321-373-3536, and I'll connect you with a lender who'll lay it all out. No pressure.